Welcome to the show. So I'm here with Jesse Brobowski from Calvert Mortgage. They're alternative mortgages that prioritize your financial success, and they lend up to 1.5 million on residential and commercial properties. A lot of great products. So Jesse, welcome to the show. Tell us a little bit about yourself and how you serve our community.
Yeah, thanks, Sam. Thanks for having us, and thanks to all your listeners for joining. Hopefully, we can provide some information that will be of value. So, in terms of our business as an alternative lender, we are laser focused on lending short term, mostly residential. You mentioned commercial. Yes, we do some, but it's very rare. What we do is lend short term residential. The bulk of that being lending to real estate investors who are buy, renovate, sell flippers, buy, renovate, rent, refinance, repeat using the BRRRR strategy, even buying and immediately selling. Like we do a decent amount of lending to people that will have bought pre-sold or sorry, pre-construction,
Okay.
and maybe they never had it anticipated to close on it, or maybe they had anticipated to close, but today because of the rate situation, or maybe they've taken on additional debt and they need to exit the property. We're happy to lend on anything residential in which there's a high likelihood of exit within 12 months. And that exit could be refinance or sale.
So how has the landscape changed? I know that with the rates and people buying pre-constructions, we've seen people that are missing their deposits and things. How have your team allowed them, how have you iterated to allow these people to close and for these deals to stay together?
Yeah, and more so what's happened in the landscape is we're seeing a lot less of that being in Ontario because of the loan just doesn't make sense from our perspective. Like there has to be equity in it. And the borrower has to be it has to make sense for them. And in those pre-cons in Ontario where they're under market, where there's just not equity in them, it doesn't make sense for us as a lender to participate unless like we sometimes we see instances where it's really tight on equity, but they have a big down payment and it makes sense for them not to give up that down payment. So we'll come in, fund it up to 85% loan to value, provided they're committed to selling and we like the property. So we'll do more of that where rather than rescuing equity profit, we'll call it, we're rescuing down payment, we're rescuing their investment into it. So that's what we're seeing a lot more in Ontario. Whereas in Alberta, particularly the market that we do the most lending in, Calgary, there's been a decent amount of appreciation. In most instances, there is profit in it for them. So that's more to the typical side where it makes business sense for them to just sell rather than hold and rent, take their profit and move on. So with those, we're happy to close on them. And in Alberta, it's quite different as it relates to how the builders write these contracts. Like very rarely will builders allow for assignment of contract. So if Sam buys pre-con, Sam has to close on it. He cannot assign it. And the builders will use trying to assign it as breaking their terms and then collapse the deal and you can't close. So in Alberta, it makes a lot more sense for our product because of the inability to assign.
Interesting. So it seems like you guys focus as if you're real estate investors, which you are, lending on deals for other real estate investors and making sure that there's equity in the property. Is that right?
Yeah, it's more make sure the deal makes sense. Like we just talked about an instance where, well, there's not equity, there's not profit. They are still committed to a certain amount and they don't want to offend that contract and lose their deposit. So we're always looking at it from the standpoint of the investor and saying to ourselves, does it make sense for the investor to do this loan firstly, and then secondly, does it make sense for us to support? Like there may be instances where it makes sense for the investor to borrow, but in order for us to manage and protect risk, it doesn't make sense for us as the lender. But absolutely, we're always looking at providing the right loan for our borrowers and for us. And there's a lot of instances where flippers come to us with a plan, and God bless you, Sam, as a realtor, because you do a great job for your clients in finding properties, which is hard. But other realtors, they don't run the numbers. They don't understand the numbers. And in turn, they'll put an opportunity in front of the client, the flipper. And then when we run the numbers, it makes no sense. There's no profit in it. or there's limited profit in it. Now we could fund those deals and make good money, but our investors won't, our borrowers. And so we'll shy away from that and we'll educate them on why we don't see them making money and why they should move on, because we view it as we're going to be in this for the next 40 plus years. And if we're supporting good investors making good decisions, then we're going to get the opportunity to work with them for a long period of time. So looking more long term. Whereas if we fund a deal and they lose, we're not going to be able to deal with that client for the long term, because in all likelihood they're going to find another way to make money.
That's a great point, because they're not going to have the capacity to borrow anymore. They're going to be taking a few steps back. They won't be able to get in front of another project. And like you said, too, numbers are important. I think your calculator was really good. We still use it. We'll actually have it linked to for our listeners. But do you still do like the 80% ARV sort of thing? I know there's different methodologies of like.
Yeah. We still do, like in Ontario, we'll still do 20 grand down, provided there's profit and ARV after repaired value. For our listeners who don't know ARV, after repaired value is at or lower than 80% loan to value. And now through the tightening up or through this downturn, a lot of the flipping activity has made less sense. But now where we're seeing what may be a floor or is more likely to be a floor than the past, and sellers are anxious to sell, we're seeing more and more of those opportunities for our real estate investor clients to do flips and burrs. It's still hard to cash flow burrs for the most part. So we are projecting to see more flips through this next market cycle in Ontario.
That's awesome. And I always thought flips are really good active income, help you gain capital so you can work on another project. How has the flipping landscape changed? You kind of touched on it. And what's the difference with Alberta that you've noticed in that market versus Ontario?
So how has the landscape changed as it relates to real estate, or at least the stuff that we focus on, flip and burr? I've talked about how hard it is to cash flow because of rates today. So the burr model is a lot tougher, although there are still opportunities, but it's just in general, it's tougher to execute on a burr today than it was back before the monetary tightening that we saw start in March 22. Flipping, again, because of market conditions, it's a buyer's market. We've seen prices decrease. Seller psychology is there, where people are trying to sell properties. For the properties that are right for flippers, those ones that are run down, under maintained, those you can get at a good value right now. And in turn, flipping is all about buying right. There's more buying opportunities than we've seen in Ontario in a long time. So that's what we've kind of witnessed over since this monetary tightening that we've seen as it relates to the Ontario market. In Alberta, because of a few components, our economy, the fact that we didn't see much appreciation in Alberta, even during the COVID period where there was significant monetary easing, we're seeing a ton of in-migration to Alberta. So now we've over the last 24 months, we've seen prices steadily increase. Now, not huge numbers like we saw in Ontario. You're not seeing those 20+% year over year, but we're seeing, 5 to 15% depending on the market. So that helps flippers. Just pure appreciation always helps your bottom line. But also in Alberta, prices are still relatively lower than most Ontario markets. So you could still buy, like, your average cost of a single family house here in Calgary is still under 700 grand, where in London, for example, it's closer to 8. And in turn, rents are higher outside of Toronto for the most part. So you still see some cash flow. There's still burr opportunities. There's been burr opportunities here all the way through, and we're still seeing our investors execute on those with profit. But it's just been an easier landscape in Alberta for real estate investors over this last 24-month period during the quantitative tightening.
That's interesting. So you're finding a lot of people still doing flips out in Alberta. Are they doing a lot of value adds with adding income, adding another unit, burrs like that? Or are they doing more straightforward flips?
A combination of, we're seeing it be really popular, adding a legalized unit and we do most of our lending in Alberta, Calgary and Edmonton. That makes up the bulk of the population. So Calgary and Edmonton and surrounding area, but it's quite easy to do a legal suite where you're now like for a bungalow in Ontario, you call it an up down duplex. In Alberta, we just call it a suited unit.
Mhm.
So it's quite easy to do and it's quite advantageous to do. So we are seeing a lot of that activity for both burrs and flips. It's just, you got, let's say you're buying the house in Calgary for 600 grand and it comes with a suited unit where you can earn, 2,500 bucks a month.
Mhm.
For a younger person or younger couple looking to get in the market, what an opportunity where, right away you have 2,500 bucks of debt servicing per month to offset your mortgage payments and to help you qualify. So we are seeing a lot of that. Now it's not like that's the the primary strategy, but it is a really good strategy that we're seeing executed very well.
Yeah, like you said, it's great for an end user or a home buyer getting into the market. Now, the lending in Alberta, do they use certain percentage? Does it depend on the lender? What percentage of the rents to go towards the debt service sort of thing?
Yeah, I'd have to. I don't think it's different than Ontario. Like I'd have to talk to my underwriters understand that very intimately, but it's not drastically different than Ontario, if at all.
Okay. Now I know we talked a little bit about like flipping. Like if someone's getting into flipping or they're starting out, I know the flipping calculator is important, having a great realtor that knows that market and knows what the ARV and the potential is. What are some ways that someone could be successful in a flip project and like what should they look for in your opinion based on you being part of the financing side?
So just buying right is critical, right? So either really it's having your feelers out everywhere for what is the right purchase. There's some great wholesalers out in the market that bird dog off market properties and are presenting opportunities that have profit in them. There's realtors like yourself who understand what makes a good flipper burr and are out there finding those either on or off market and presenting those to their clients. A lot of clients take the direct approach where they're the ones door knocking and putting flyers in mailboxes. You're going on Google and optimizing, a buy your house for cash type campaign. So it starts with finding the right property. But even finding the right property, what is the market in which you want to do your flipping or your real estate investing, right? What is the right location within Calgary? Ideally, it's somewhere where you can get to and project manage. I highly recommend not trying to project manage from afar, especially when you're new. Like we have some real estate investors who are extremely seasoned and who can very competently manage multiple projects from multiple locations. But where we've seen a lot of risk in the past is when people try to manage a property 1 hour drive away. It's difficult to get to, difficult to follow. So that type of stuff. When picking a location, like what are the market fundamentals?
Yeah.
What does the economy look like? What does the prospect for employment look like? Looking at the market specific, what kind of inventory is there? Is it a buyer or a seller's market? Are you seeing prices increase? Are you seeing them decreases? Are you seeing them flat? We've seen people execute burn flip strategies in any market because again, if you're buying right, and yeah, let's say the market is going down 10% a year, and by the time you flip it, you're 6 months in, and your value is 5% less. Is if you're buying it at a song, you can easily be profitable just in spite of market conditions. So just doing your homework, understanding where you want to do the flipping, why you want to do the flipping, where you're getting the deal from, and then what type of renovations you want to do. Like if you're a seasoned tradesperson, you can take on a larger budget. If you're not, you might want to just do cosmetic, change out flooring, paint, maybe some drywall, maybe some appliances. It always makes sense to look at some easy, quick kitchen and bathroom repairs because those add the most value. You might want to avoid suiting the downstairs because of the complexity with that. So, thinking through what your capabilities are and finding the right project for yourself is important as well.
Now, I like you're being conservative too, because if you buy a good property, you add value to it, add income, it's going to probably cash flow in a good market or at least do pretty well. And it's going to allow you to increase the value of that property and then do better on that project, whether you refinance it later or you add more units to it after or do something else with it after. So I think it's really interesting. So when you talk about we talk about dating the rate and marrying the price. I know a lot of people that we've talked to have what they bought when the rates were lower and the prices were higher. What's your take on that when it comes to, now being a potential opportunity for buyers, investors? I think there's more optimism, but also when it comes to, the rate not being everything, but really what the price that you buy it at. Can you share with me your take on that?
Yeah, buying it goes back to buying right, especially if you're going to hold it long term, right? Like, what is the location? What are the prospects for the economy? And if it's a good location and the prospects for economy are good, then in all likelihood, you're going to see some appreciation. Banking on appreciation is a tough sell. I think any astute investor wants to focus on cash flow if they're going to hold it long term. So, maybe today you might buy it, you might feel that the market is near bottom. So you'll enter knowing that there's a likelihood that your rates are going to decrease over time. Again, it's tough to speculate on these things. So
Yeah, no,
I,
it
I,
is. Yeah.
I ideally you're buying a place that at least is not draining you from cash flow, even if it's cash flow neutral, if you're going to hold it long term. But if you're just going to add value and rent it, then you're not really dating the rate. You're dating both the property and the rate because you're in and out. So it all
Yeah.
depends on what your strategy is. Like if you're going to hold long term, certainly you'll want to be very cognizant of what that cash flow is and what your capital outlay is and not avoid speculating as much as possible.
Yeah, absolutely. I think that's where the doing the numbers and understanding the area, the zoning, what's possible with what the maximum value is in that area. We had a client do a triplex conversion. It was like a 5-month project, lots of great learnings, and it came out well. And it actually ended up cash flowing him in Ontario, which was pretty great. So when you say prospects for economy, let's say someone's getting started in investing in Alberta, they're in Ontario, or they're wondering about what if that's a good market for them. Can you dive a little bit deeper about prospects for economy? What do you look for? What's important about that?
So we look, from a more macro scale, we look at what is employment, what like what are your employment numbers? What is the unemployment level? As it relates to employment, what are the average earnings? So, and then we look at GDP per capita. Is that increasing or decreasing? We look at migration. Is the population growing or shrinking? And then in turn, those will have a direct impact on the demand for real estate. And the demand for real estate plus the economy will have a direct impact on where prices go. So we don't want, as a lender, to be lending into smaller markets. Those just naturally have stability, right? Like if one of the economic engines stops, typically you'll see big out migration, you'll see big decreases in values. So we try to stay away from lending in areas with 50,000 people or less. We try to stay away from lending in areas where the economy is concentrated on one industry. I say that being a lender in Alberta where our economy is still concentrated on energy. So one of the big reasons that we decided to diversify into Ontario was because of the volatility that we've seen in Alberta being such an energy centric economy. So you're asking about
How
looking at
has
the
how is
economic
I was
prospects.
going to say, how is you talked about migration, like has that put more pressure on the economy when it comes to the energy being energy centric, and they're focused on that's their one, let's say one big measure of success in that economy there is the energy, right?
Yeah,
Has
our primary driver in Alberta is energy, and the balance sheets of the energy companies are currently strong. They're investing, so we're seeing an opportunity for employment in that industry, but also through migration. You need more services, more dining and entertainment staff. We've in Alberta have started to build out a fairly successful tech industry. So we're seeing young educated people start to move here and more be able to find work in technology. The startup ecosystem is more robust here than it's been ever. still not a leader in North America by any means, but we've seen a lot of investment and a lot of startup companies be successful. So which in turn you need educated people to come and fill roles for those opportunities.
That's excellent. And I talked to a lot of people. Some of them are actually moving out to Alberta. They're looking at their strategy. They're either reevaluating their portfolio here or selling underperforming stuff here potentially. When people are moving to Alberta, where do you find that they're moving from? Are they moving from certain areas of Toronto, bigger cities in the region
Yeah,
here?
I don't think it's we're not I there's not a specific the theme that we're seeing. It's not a specific region, but the theme that we're seeing is you have young, educated, ambitious people looking to start a life, looking to own real estate, looking to have a high quality of life, and it's becoming harder and harder to find in the GTA because of cost of living, congestion, um, even employment numbers, and you have a lower cost of living. You have higher average earnings here in Calgary than you do in GTA. You can still afford a home. Even a downtown condo today, you could still buy it 350 grand for something really nice and within 5-minute walk to your office. So those are kind of the drivers. And now I'm I I'm saying this, not that there's not a ton of really great stuff going on in Ontario. It's just it's a different economy, a different dynamic here in Calgary and Alberta that we're seeing. So we are still, as a lender, very confident on the future economic prospect of Ontario as a whole and the GTA. But we're seeing an interesting trend happening with more and more migration to Alberta, particularly Calgary, and to us it makes sense because of all the things I talked about.
Oh, it makes a lot of sense. I noticed that your services, you obviously do tax debt consolidation, you do the BRRRR. When someone comes to you and they'd like to either expand their portfolio, buy a first or second investment property, what do you advise on how they get started? Do you do like a budget worksheet with them? Do you figure out if they have unknown taxes? Do you consolidate things? Do you wrap that up first and then you look at with properties with the client? Like, how does that work when it comes to?
Well, it works however the client wants it to work. Ideally, we're doing that work up front with the client. Like if you're looking to invest in real estate, let's have a discussion. Let's understand what your financial picture looks like. Let's understand what your goals are. We love to pre-approve the borrowers through that process. So, okay, Sam, we've done the work. We understand your financial picture. We understand your credit. We understand your employment. We understand what you want to do as an investor. Go find a property. If you find a successful property, we'll lend you up to we love to pre-approve you up to, let's say, $1 million. If you find a successful property, we know you have this capital, get out there, get it. And now we have all the we call it the covenant, like the borrower is the covenant. So we have all the work done on underwriting the covenant. Now it's all about underwriting the opportunity. So ideally, if you're interested, you're reaching out to us, specifically our underwriters who are a lot more versed and smarter than me at qualifying you, and also a lot smarter than me at getting you on the right track, spending 10, 15, 20 minutes with them, even longer. Like, we're happy to invest in our borrowers because we believe that the more we do that up front, the higher likelihood of success and the less back and forth we'll have in crunch time when we actually have an opportunity to underwrite and approve for you.
Yeah, I like that you take a stepwise process too, because it seems like you said you underwrite the client first, make sure that everything's good to go, and then you look at the opportunity. You say, okay, here's your budget. Now, go ahead and go look at an opportunity based on your financial picture. So you sort of map it out. You go backwards based on the client's goals and what they want to accomplish with their real estate investment or their portfolio. Is that right?
Yes.
Excellent. So I know lately there's been a lot of, private money, there's been syndications, there's the things like that happening. What should people look for when it comes to lending in a project? What are some red flags? What are things that they should look for when it comes to there's tons of, emails about syndications and things like that. What are some things that, you advise people to look for, and do you have any opportunities for people when it comes to, lending and et cetera?
So the question is what to look for in a lender?
it not only a lender, but when you're lending. So let's say someone
Oh, as us as a lender.
yeah, become a lender. Let's say they want to lend on a property, or there's a syndication that's being offered. Is that something that they could not look at? Just things like this, like kind of, your take on it based on your
Well, my
experiences.
take on it is being a mortgage lender, as we've just talked about here, like understanding credit, understanding capacity, understanding all the things that go into making a credit decision, plus making sure that you're securing yourself with a mortgage, plus understanding what to do in the event of default, plus having the capacity to work through in the event of default takes a high level of sophistication. So we've seen, and it's particularly in Ontario where there's been 20 years of really good times, and really good times mask really shitty decisions.
Yep.
And in turn, we're seeing the tide go out. And there's a lot of great lenders out there who they're not swimming naked, but there's a lot of people that are. And we're seeing that. So just think about what your goal is in as an investor, and what your level of expertise is. So directly lending takes a significant level of expertise. We see people being successful that have done it for many years, that have managed through various cycles, that have significant capacity to to withstand issues with liquidity, right? Like a mortgage in nature is not liquid. So if you're investing, if you have 100,000 and you're investing 100,000 into a mortgage, you better not ever need that 100,000, because if you say no, I don't want to renew, and the borrower can't pay you out, then guess what? It doesn't matter if you say you don't want to renew, you're stuck with them. You can foreclose, but that may create a negative outcome for yourself, right? Like in the wrong environment, your borrower may be underwater, and in turn you're underwater. So thinking of being a mortgage investor, understand what your level of expertise is and where your limitations are. There's a lot of great mortgage investment corporations out there who have significant experience in managing through risk, and in all likelihood would be a good option for you. Individual private lenders, the ones that we've seen be successful, are those big family offices, like the guys that are managing, tens of millions of dollars, have the capacity to make these decisions, have really good lawyers talking to them and advising them. The ones that we don't are these, you know, ma and pa syndicators where they're putting other people's money at risk, and they don't really their main job is not underwriting and lending. Their main job is likely just selling the opportunity, which in order to properly sell the opportunity, you need to be able to understand the risk. So it's just being really cautious, and going and seeking yield is inherently risky. So a 14% deal, in all likelihood, when you do if you were doing analysis versus a 12 or a 10% offering, there's going to be more risk with the 14%. That doesn't mean that risk is good. We're in the business of managing risk, but you need to understand what that risk is, and properly make decisions on if that's your best investment opportunity. I guess long story short is, unless you're an expert in mortgage lending, there are experts that you could put your money with in through a fund of funds. And where we're seeing a lot of risk right now is with lenders that didn't have their eye on that risk ball, that didn't really understand how to properly price and manage mortgages. And in turn, it sucks to see, but I think we're going to see more of that unless the market picks up significantly, which I am not anticipating, right? Like, I'm anticipating us seeing more sales. I'm anticipating the Ontario market coming back as it relates to activity. But are we going to see a 5% increase? Very possibly. Are we going to see a 15-20% increase, which masks a lot of poor decision making? I don't think so. So, and it sucks because what I just talked about, a lot of the people that are putting their money in with the less sophisticated mortgage lenders are the less sophisticated themselves, and in turn the ones that can't afford to lose. Yet they're it just breaks my heart to think about some of these stories that we're starting to hear. And I see it. I've met these people who are putting these syndications together, who are selling these people invest in RRSPs who are bringing in investors that have a lower level of sophistication and knowledge, and in turn likely putting their money at more risk than the ones that do know how to manage it. So it really sucks to see and hear. And I don't know how you manage that other than through, and I'm a capitalist. I love I love it when the government sets us up with less restrictions so we can make really good decisions. But there has to be a certain level of regulation to protect people from themselves.
Yeah, there's lot of interesting points. Like you mentioned, managing risk, having the right mortgage investment corporation, the sophistication of the investor, making sure that they do their research on the lender, and that it is a very sophisticated game. I mean, you have to know the property. There's probably a lot of logistics and underwriting answers in there about how they show the risk, how they manage the risk, how they show their clients, how they're calculating the project and getting people to safely invest in a project rather than just being like a makeshift kind of syndication in a way. So
Totally.
yeah, for sure. So when it comes to that, I mean, is there, with these mix, like with these mortgage investment corporations, they still syndicate, they still bring like a GPLP structure? Do they bring a whole bunch of people to the table that are not securing their money on anything, but do they show the clients exactly the risk and how they're mitigating that risk or managing that risk when it comes to the project versus someone who's just sort of, mom and pop shop kind of syndication? What are your thoughts on that when it
Yeah, I
comes
think
to?
it just depends on the company. Like most mortgage investment corporations, they're a pool of funds. They're not GPLP. It's just
Right.
you invest, you buy shares. That share price is based off of net asset value. Net asset value is typically just the mortgage money you have out, and then they'll earn money through the interest income and fees. And then where MICs are obligated to push out their returns every year to their shareholders. They can't retain earnings. Then those shareholders are charged interest income and in turn pay taxes on that. Now, the bulk of the lenders out there are really great MICs who have really good risk models, who have strong governance structure. Like you talked about what they report, because they're private companies, there's no the reporting principles are predominantly related to accounting principles. So what they must report. Now, the Securities Commission regulates a certain amount of disclosure on a quarterly and annual basis to shareholders, but it's not nearly as what a public company would be reporting for the most part. So there's guidelines, there's regulations, but it's very inconsistent in terms of how much of your how much insight you're giving to your shareholders in terms of details of your portfolio, where it is you absolutely have to report on what arrears look like and what losses are, but it's different. And then you talked about syndication. Syndications is a different animal in and of itself. Typically, what works best is the lead, we'll call it, right? The one that's arranging the mortgage. They gather all the documentation, they write up a summary, and they send everything to the syndicators. They say, here's all the information. We're looking to syndicate X amount of money, first come, first serve. And ideally, these syndicators are sophisticated investors that understand risk, right? That this isn't their last 100 grand, that they literally have millions they're going to put in, 2, 3, 4, 5% of their portfolio into loan.
Yeah.
That's ideal. But what we see is, which I think is crazy, is yeah, let's syndicate this deal. Grandma with literally 100,000 in RSPs is going to put in $50,000. Grandma shouldn't be in that syndicated deal. And we have in Alberta, syndications are considered a security, so we have tight rules around those. And in turn, there's not many mortgage syndicators because of that. Whereas in Ontario, you have they're not regulated quite the same, and you have a lot of syndicating happening. And unfortunately, because of the lack of regulation, I think it's happening with people who shouldn't be putting their money into syndicated mortgages.
No, that's really good. There's a lot of take homes there, and probably any listeners should kind of listen a couple times to really see and unpack what you mentioned there.
And
So
it's
just
important. Sorry, it's important as well. Always have, what is your security? So when you're a mortgage lender, you should have a mortgage on title, right?
Yeah.
whether it be a first mortgage or a second mortgage. What's the loan to value? What I'm hearing now is that there's people that have invested in these promissory notes and they're not secured to nothing. They're vapor. Don't do that. Don't
Yeah.
raise money through these and don't put money into these.
It seems like some syndications, like you said, they're just grouping together a whole bunch of those promissory. They're not feeding the information, all the information about the whole project, like you said, to all those people part of the syndication. And they might be, like you said, they have to have a high tolerance for risk, and they have to have a
Yes,
lot of capital and a lot of cushion because these people, or sort of like angel investing, like they've kind of have their portfolio, have a lot of money. They don't have to be concerned about that little bit that they're investing based on.
exactly.
It's awesome. So Jesse, as we're wrapping up, tell everybody where they can reach you, how you can help them out, whether it's a real estate investor or someone that owns property or is looking. What are some things that your team's known for as far as how you can maybe help them so we can have them reach out as well?
Yeah, we're known for educating. So we talked about our underwriting process. If you're interested in learning more about borrowing from us, about investing in flips and burrs, you can reach us. We have a great Instagram feed that's predominantly, case studies, tips for flips. Here's where the meetups are happening. It's at Calvert Home Mortgage. Our website is chocked full of case studies, papers, tools. Like our flip analyzer, you're going to make it available, Sam, to
Yep.
your audience, but it's there. It's available to the public. We want people to use it. So visit us at chmic.ca. And if anybody wants to follow up with me directly, feel free to email me, Jesse, Jesse, at chmic.ca, or just Google us and give me a call.
And I'll link it in the show notes. Well, Jesse, it's been really great chatting with you and understanding your business, how you guys help investors. I know you had a lot of experience with burrs, flips, and construction loans and all this stuff. So really appreciate your time and your expertise today.
Thanks, Sam. Thanks for having us.
Thanks so much, Jesse.
Bye bye.